Everyone on YouTube says these are yield traps, and honestly, they might be right. QDTE yields over 44%, GDXY throws off massive income, and Chippy honestly scares me the most right now. Most investors look at these ETFs and see destroyed NAVs, unsustainable payouts, and a retirement disaster waiting to happen. But here's the thing. I didn't buy these ETFs to build wealth. I gave them a job. Because I started investing late. I didn't begin until August of 2022 because I thought a 401k alone could somehow be enough for retirement. So instead of pretending these are perfect investments, I used them as my first layer of retirement income. And that changes everything. Because when people talk about yield traps, they usually ask, will this outperform the S&P 500 over 30 years? That's not the job. The job is income, specifically high current cash flow today, while I continue building the rest of my portfolio around it. And yes, there are risks, a lot of risks. That's why I think context matters more than yield. Let's start with QDTE. Right now, I own 133.74 shares at a cost basis of $31.13, and it is trading at $31.42. And the big headline, the current yield is about 44%. Actually, if you look, the yield is 44.33. And this is my portfolio. If you come over, that position alone is producing roughly $1,845.61 in dividend income. So if you're a total return investor, you probably hate this ETF already, even though my yield on cost, my total return on this is 33.48. And honestly, I get it. These type of funds can absolutely become yield traps. Investors think the payout alone equals wealth creation. But again, I'm using QDTE differently. I'm using it as a cash flow tool. That income can help support future investing, future retirement income, or eventually reduce pressure on selling assets later in life. Quick question for you guys. Would you ever use a high-yield ETF for income if you fully understood the risks? Or do you think all yield traps should be avoided completely? Let me know in the comments because I think this debate is way more nuanced than people make it sound. And if you enjoy honest investing discussions without the fake guru nonsense, subscribe because that's what this channel is built around. Also, what do you think constitutes a yield trap? What do you feel is too high of a dividend yield? And then there's GDXY, which is the UMax Gold Miners Option Income Strategy, ETF. I currently own 164.96 shares at a cost basis of $15.74. The share price is currently around $13.32. And yes, this is exactly why people call these funds yield traps. The share price decline is real. When I bought this, I bought it as something to give me a little diversification from the S&P 500, from the NASDAQ 100, and gold at that time was on a hot streak compared to the dollar. But geopolitical things have gone on with the war in Iran, not realizing that gold miners use a lot of energy, and when energy prices spike, it does affect the price of that ETF. But despite that, this position is still generating around $1,392 per year in dividend income. Actually, that is $1,392.26 in dividend income. So the question becomes, what role does this play in a portfolio? For me, this is not a core long-term wealth compounder like SCHD or an index fund. This is a high-risk income layer. That's an important distinction. But the one that honestly makes me the most nervous right now is Chippy. Chippy is the UMax Semiconductor ETF. And currently, that's been on a huge hot streak. I own 24.18 shares with a cost basis of $58.80. The current share price is around $74.90. and currently it's paying me roughly $525 in income. Now, on paper, that's amazing. That's my total return, 38.25. My dividend yield, which is just a touch over 30%. Yield on cost is fantastic. It's one of my smaller holdings, but it's already paying me $525.92 in annual dividend income. So now, on paper, this looks amazing. The price appreciation has actually been unusually strong compared to what most people expect from yield max style ETFs. And that is exactly why I'm cautious. GDXY has already taught me that geopolitical situations can affect share prices. Most semiconductors, most of these chips are produced in Taiwan, which means if there is something going on with China that affects it, that could seriously affect what this ETF is going to do. But is it because performance like this isn't really typical for these types of funds? A lot of investors start believing strong performance will continue forever right before things reverse. So unlike QDTE and GDXY, where the risks are obvious, CHPY worries me because success can sometimes hide risk. And this is where I think the internet gets investing wrong. People want one investment to do everything. Grow aggressively, pay huge incomes, never fail, beat the market, beat safe. But that usually doesn't exist. So instead, I'm signing a job. I'm assigning jobs. Some investments are there for long-term growth. Some are there for stability. And these high-yield ETFs, they're there to generate income now, not forever, not at unlimited size, and definitely not without risk. So when used intentionally, I think they can serve a purpose. So no, I don't think yield traps magically become safe investments. And I'm definitely not saying everyone should run out and buy QDTE, GDXY, or CHPY. But I also think dismissing every high-yield ETF without understanding why someone owns it misses the bigger picture. For me, these are tools. Risky tools, but tools with a job. And as someone who started investing late, building retirement income streams matters to me a lot more than sounding intellectually pure on the internet. If you enjoyed this video, hit the like button because it really helps the channel reach more investors. Subscribe if you want more honest conversations about dividend investing, retirement income, ETFs, and the mistakes I'm learning from it in real life. Also, too, if you want to see more about the real important metric when it comes to investing, total return, watch this video, and I will see you in the next one.